Unsiloed podcast is produced by University FM, elevating the stories of your institution.
Welcome to Unsiloed. This is Greg LeBlanc, and I'm here today with Ilya Strebulaev, who is a professor at Stanford Graduate School of Business, and also the author of this book, The Venture Mindset. I don't have the book, obviously. It hasn't come out yet.
I don't have it yet as well.
Right. How to make smarter bets and achieve extraordinary growth. Welcome, Ilya.
Thank you, Greg.
I should mention it's co-authored with Alex Deng, who is...
It's co-authored with my former student.
Yeah.
He was one of my 2,600 students now,
yeah,
who graduated back in 2015.
Well, what's interesting about the Stanford teaching model is that there are a lot of classes which are co-taught, right? So you have an academic and a practitioner, or an academic with lots of practitioners. A lot of the classes that I teach, I spend about half the time in front of the podium, and the other half of the time I bring in people. And I think this is a very useful way to do teaching. We do it at the executive level also, of course. But the focus of this book, you said you wrestled over the title of the book a little bit. It's called The Venture Mindset. And the reason why I found that interesting is that, you know, when I teach venture capital, I spend a lot of time talking about legal structure, right? I talk about the ecosystem. I talk about bankruptcy law and intellectual property law as being precursors. I talk a lot about organizational form. I talk a lot about designing incentives. And you mentioned all of those things, but you really focus on the mindset. And I was wondering, should we be thinking about a mindset the way we think about technologies, right? Things that are innovated on and then diffused, right? I mean, can the dispersion of this kind of venture mindset help to improve the performance of all organizations, not just ones that are venture-backed startups?
That is a great question, Greg. And first of all, how it came to know venture mindset, and then I'll go to your specific question. You know, I've been here at Stanford for 20 years, and I have been teaching finance. And when you teach finance, you teach a lot of stuff about how organizations make decisions.
Wait, did you start off teaching the core at some point?
I started teaching advanced corporate finance.
Right.
And hopefully some students still remember how I taught the classes on advanced corporate finance, which is how organizations make decisions, how they, for example, decide on the investment projects. And very early on, I realized is that there is a backbone. There are financial models. There are legal structures that are also important. But even in those more traditional financial decisions, you need to have some bigger vision. You need to have the process of how you make decisions, the mindset. And then I became fascinated by venture capitalists. And I became fascinated because initially when I met them and I looked at how they make decisions, it turned out to be that they're making decisions very counterintuitively.
It doesn't seem like finance at all.
Very often, well, they're making financial decisions at the end of the day, okay? As a venture capitalist, I'll decide whether to invest in you or not to invest in you if you're a startup founder. So that is a classical financial decision-making, you know, positive NPV and so, etc. But venture capitalists don't approach it this way. In fact, years later, and about now 7 or 8 years ago, we conducted a major survey of venture capitalists of over 1,000 VCs from over 800 firms, a non-trivial fraction of all the VCs operating in this country. And it turns out that most of them don't use any of those tools that we're so proud to teach in basic and advanced finance courses. And what I realized after I became fascinated and started studying how they make decisions is that even though it is counterintuitive, of course, they're doing it for a very good reason. They're doing this, you know, not just to succeed, but just to survive, because they face a very different environment from a person who is making a decision in our traditional financial world, traditional organization, and they had to develop a certain playbook, a specific playbook for them, and that is what we eventually called the venture mindset. And I'm thinking about the venture mindset is that everything you mentioned, legal structure, you know, and at the end of the day, a lot of financial stuff, all of this is important, sometimes critically important. But this is kind of the backbone. But the real meat that makes venture capitalists at the end of the day successful, their secret sauce, so to say, is the venture mindset. Now, not all the VCs use them, but smart, successful VCs do. More importantly, I think, is that they've been using it for 50 years, successfully. And the question is that why nobody else used it. Now, when I say nobody else, in fact, that's not correct. In the book, we give a lot of examples about companies that used the venture mindset even before venture capitalists appeared on the scene.
Well, that's the real option approach, right? So I think probably if you were like me teaching corporate finance 20 years ago, right, there was the traditional NPV approach. But then we got really excited about real options at the time and how they were used to value things like, oil wells and, movie sequels and pharmaceutical products, right? And that's sort of like the academic bridge.
Yeah, it's interesting because I think what we call real option and what we call in the book kind of double down or quit. Because if you think about options or real options, you're kind of facing a branch every time. So you decide what to do. You never commit to a project. You always say, well, we are either double down, meaning that continue investing, increase our investing, or we decide to quit, which is very different from a traditional NPV approach. Traditional approach that you and I, you teach, maybe I used to teach in basic or advanced corporate finance, which is the way I think about NPV when we teach it to MBA students is take it or leave it decision. And in fact, many large companies approach their budget allocation, their investment project decisions as take it or leave it. Just think about, let's say, Airbus making decision on what they call project A3XX that became A380. They did a lot of planning. Okay, they spent millions of dollars on consultants, and then the board voted, the CEO decided, the governments agreed, and they went ahead. That was a take it or leave it decision, and then later on,
it's irreversible.
That is, I think
they treated it. I think upon evaluation,
that is critical because most decisions in life are reversible. Not all, but most, definitely in business. And it's about, as you said, Greg, correctly, treating. So you treat decisions as reversible. So real options treats all the decisions as reversible. Now, but what is fascinating is that this is only one out of many, many tenets of the venture mindset. And I'm thinking about the venture mindset as two-layer. First, the first layer, there are kind of principles that you follow, and we identify 9 in the book, which is based on all this research that my team and I have done. And double down or real options approach is only one out of these principles. In fact, it's one specific application of the bigger principle. So it's one, okay? And then the second layer is mechanisms, because it's great to say, let's use real options. Sounds cool, okay? And when I was a PhD student and learned about it, sounded very cute as well, like fantastic. How do you apply it?
Right.
How do some companies apply it? And the same applies to all the other principles.
It'd be great if you could just grab the standard deviation.
No, you can't.
Distribution of the future outcomes.
No, you can't.
Right.
Neither in the world of startups nor in the world of large organizations. And I think that is why the venture mindset, in my opinion, should become a movement, like open innovation movement or the blue ocean movement. The reason behind that is that venture capitalists and some venture-minded organizations use those principles for many, many years, in some cases for decades, and became quite successful. But that is because they have been historically surrounded by a very, I would say, hostile environment. For example, an environment where most ideas fail, where you cannot afford to finance all the ideas right away. So you finance it as in the real option approach, step by step, where the identity of a person who is doing this is often more important than the identity of the project itself. Sometimes there is actually no project, kind of. There is no business plan. There is no product yet. There is no market yet, but the team members are very important. And when you face all these environments, on top of that, there is a disruption happening where a lot of new industries appear, and incumbents face competition not from other incumbents, but from newcomers. And suddenly, this venture mindset that I think was mostly not needed for most companies, the truth is. If you were in 95% of all the companies in the US or abroad, you do not need the venture mindset. But now you do.
Well, that was one of the questions. I spent a lot of time trying to convince people to think more like VCs and less like CFOs, right? Where the CFOs use this NPV approach that you learn in your intro finance class, and the VC approach, the one you learn later. But I mean, certainly there are boundary conditions, right? So there's going to be certain types of organizations and certain types of environments that are going to benefit from the traditional CFO approach, and there's going to be others that benefit from the VC approach. Is there, what defines that boundary? Is it the sort of the rate of change? Is it when we see the rate of change accelerate, that means that we need to kind of shift more in the VC toward the venture mindset?
That's a very good question. I would say, first of all, it's not about the organization. It's about various times when you need to use the venture mindset, and the various times when you need to set yourself up to use the traditional mindset. So typically you would expect CFOs to use the traditional mindset. They're kind of, the keepers of the safe, okay, in any organization. But sometimes even CFOs need to use a very different approach. Let me give you a specific example. So I work a lot with large corporations on their corporate venture capital initiatives. Very, very popular these days, okay? And it's just an illustration why the venture mindset is needed, because large companies say nowadays, oh, wow, we need to get on this bandwagon of startups, funding, of working with startups, either because there's a lot of opportunities or because maybe they're worried about their future. There are now more than 1,000 corporate VCs around the world. So I work quite a lot with these organizations. And obviously, the head of CVC, is almost by definition is worried about the parent company's chief finance officer. Why? Because typically chief finance officers care about the bottom line. And from their point of view, investing in a startup is a money-losing proposition. Well, NPV is negative, okay? Now, here's where the venture mindset approach can be very important. So the way traditional organizations set up, they think about individual projects. So if you think about this, and this is what your traditional finance will say, which is, look at the project, and it has positive NPV, let's go. If it has negative NPV, let's not do it. And all this stuff we spend is trying to figure out whether it's a positive NPV or negative NPV. And that's where CE4 methods are very important. In early stage venture, that is not a good approach. It's not a good approach not because the NPV approach doesn't work, but because you cannot use it with respect to a single idea. So one of the points of the venture mindset is to say, we are not going to approve. If I'm the CFO of the company, I should not be participating in approving, so giving my nod of approval to every single investment project that this corporate venture arm is bringing to me. They're very small typically, maybe, $2-3 million, which is nothing kind of for a $1 billion corporation. I'm not going to approve it. It doesn't mean that I abdicate my responsibilities as the chief finance officer. I think the parent company, and including the CFO and other executives, have a hugely important role in using the venture mindset, developing a portfolio approach. Because, let's say, corporate VCR might invest in 25 projects. And yes, if all of those 25 projects completely fail, not a good idea. Okay, that was a negative NPV project. If one project fails, it tells you absolutely nothing. And this is one of the major struggles of corporate VCs, because they're getting very often judged on the short-term performance of a very specific project. Okay? And very often it requires somebody like me to come in and talk to the leaders of the organization and to explain to them that you're in fact very needed to apply what you're applying, but at the portfolio level. And once people realize this, they say, oh, here we have to use this different approach that I call the venture mindset.
Now, part of this mindset is about how you make decisions. And in the world of JDM, right, we talk about thinking fast and thinking slow. And you talk in the book about how you need to have the capacity to move very quickly through certain decisions, right? Look for red flags and be very ruthless in winnowing down your options. But then you have to slow down and do your due diligence. So how can one know what gear to be in, right? How do you adjust these gears? Because traditional judgment decision making sort of says, hey, let's take in as much information as possible. Let's look at all the different criteria. Let's aggregate everything and use some kind of rule. I mean, how do you avoid slipping into biases and prejudices and rules of thumb that are dysfunctional in some way?
Okay, so there's a lot of stuff here, okay, to unpack. But let's take a step back. So I've just been to lunch with Jensen Huang, who is in the news now as the CEO of NVIDIA. And you might think that the CEO of the second most valuable company in the world would be extremely busy and would have no time for anything. Now, what amazing thing that he said is that he has his priority list. Okay, now he's managing $2 trillion company, 30,000 employees, and so on. But every single evening, after dinner, he spends time learning. Every single day of the week, he spends time learning some new stuff.
We talked about how he goes and buys these textbooks, right, to learn how to do stuff.
So he never wants to write a textbook, but he reads all the time, reads all the textbooks, reads archival papers, etc. Now, on the one hand, wow, it's amazing to hear this. So how many CEOs do you know that spend 3 hours or whatever, 2 hours every evening reading stuff and thinking about the future, or just trying to understand what is happening in a new field? But in fact, it is a part of the venture mindset. One of the principles in the venture mindset, and exactly it comes to the decision making fast and slow, is you have to come what I call, and this is from a very famous French scientist, Louis Pasteur, from the 19th century, the prepared mind. So if you, in fact, spend a lot of time preparing yourself, then when you see something snaps in your mind and it seems like, oh, it's a very fast decision. In fact, the smartest decisions are never fast. You just prepare yourself for this decision. Okay, so that's the first thing, which is, I think all of us can actually benefit from this venture mindset, prepared minders. And, whenever I meet or and talk to or study successful VCs that repeat this again and again and again, sometimes you might think, oh, it's luck. Like he or she met this entrepreneur, okay, and found, oh, wow, well, let's invest. No, that is not the case. So let me give a specific example. One of the first cases I wrote when I started teaching venture capital at the GSB was on Dropbox. Now, at the time, Dropbox was still a Series B company, but was definitely on the way up. And we had Drew Houston, the co-founder of Dropbox, came in. And here is what happened with Dropbox, is that the VCs that invested in Dropbox for the first time, okay, in 2007, 2008 frame, file sharing idea was out there. It was not possible yet because iPhone was just released or was not yet released. But it was out there. In fact, there was an online publication at the time, Mashable, I think it was called, that listed like 50 or 80 all those sharing startups. Okay.
SugarSync, I remember that one.
Yes, and well, there were a lot of them. Okay. Now, and VCs who invested at the end of the day in Dropbox, and by the way, there were just a couple of companies on that list that survived. So Box is another one, okay? And of course another one is G Drive. What we know now is G Drive. So the VCs who did that, who invested in Dropbox, they saw the guys and they decided to invest right away. So you might think, well, that was kind of luck. No. In fact, they thought for a long time, like Jensen Huang, they spent days and days preparing themselves. learning everything about this file sharing, the future, the technology, the market, how it's going to work. And then they met, some of them with every single startup. Every single startup in the Valley and beyond that was trying to develop file sharing. And then when they met with Dropbox guys, who, by the way, didn't have money, they, I actually believe, arrived from Boston, from MIT, on bus, because they didn't have money, okay? And they couldn't do anything because there was still no technology available, even though it was coming, okay, out. They knew, these VCs, from the very beginning that this is something. Because if you, Greg, if you consider yourself a very smart person, as you are, and spend the entire year thinking about this, okay, meeting with people, and suddenly you meet two young guys, and in 30 minutes, you learn something new. You've learned something that you do not know. And they could answer all your questions because they thought about all those kind of scenarios and possibilities. And so with this prepared mind, you invest right away.
So it seems like curiosity is a superpower of the venture mindset. You didn't use that word in the book, but you talk about getting outside of the four walls and just trying to harness as much information as possible from unusual sources. I actually ran into Drew Houston at a party, and I didn't even know who he was. And he just started asking questions like, hey, how do you think we could improve Dropbox? And I was like, you don't know me from Adam, and you're asking me questions about how to improve your product. What is the obstacle to why doesn't everybody have that? I mean, someone who's like me, I've been curious since I was born. I don't get why people stop being curious.
First of all, Greg, let me tell you a story, because this Drew Houston's Dropbox story, where he's going out and asks people, customers, like, what can you do to improve it? That is, of course, an example of the venture mindset. Okay, what I described as a curiosity, I think it's not just curiosity. I think it's a mindset of understanding that you should talk to people whom you don't know. You should talk to your customers whom you don't meet every day. Sometimes you should meet with people out there. Okay, let me give you an opposite example, because not everybody is like Drew Houston, and yes, most smart VCs are like him. Okay, so I'm giving quite a lot of executive sessions to the leaders of large global companies, and here's one some years ago to a large financial institution, very large. Very, very large. And there's maybe 40, 50 executives. So there are the CEO and the top executives of that financial institution. And we're doing all this stuff and discussing what later became the venture mindset and decision-making process. And at some point, we're doing this exercise, and it turns out, when I asked them, so when was the last time you spoke to any of your customers? And there was a silence, and then one said, well, I just had breakfast with my wife. She's our bank customer. I said, no. When was the last time you spoke to a customer? Or potential customer, whom you know, or even don't know, but only as a customer? None. Zero. Not a good idea. Not a good idea. And so the traditional executive mind, I think, is you work within your four walls. You talk to your colleagues. There's a lot of politics involved. You actually spend all this time on this.
Not invented here syndrome. You talk about that, right?
Including that. But then you don't talk outside. That's actually what VCs do. Now, and also people like Drew Houston, like founders, CEOs who are VC-backed. Because I think that's, I don't like using DNA very much. It's kind of, I think, misused word in this case. But it is what we would say entrepreneurial venture mindset DNA, where you always use an opportunity to learn something, to be more prepared. So I think it's going out, and I can give an example of the venture mindset principles that I'm utilizing myself. So what I've learned from the venture mindset over these years, to speak to people to whom you in a typical situation would never speak.
Well, I mean, in academia, it's actually not that common, right? I mean, you go to the workshops right.
And you know everybody.
and you see the same people at all the same conferences if you have a specialty, right?
Absolutely. And I think that it's not a good idea for science as well. So nowadays, first, when I travel, and I travel quite a lot, okay, my goal is, so whenever I go into a business lounge, I'm standing in line at the check-in, okay, or if I'm sitting next to somebody in the plane, my goal is every single time I have to talk. And these people, and frankly, you know what, for a professor, okay, for initially somebody who was an introvert, just because otherwise it's very difficult to become a scientist, it was not easy.
Well, Jensen Huang said he also was an introvert, and here he is.
And
talks.
here he is giving an amazing talk. I'd love to be able to give talks like him, okay? Because he has a prepared mind. I'm sure he also read books about how to give speeches. And so initially it was very difficult, I have to say, and kind of very strange, because when you travel and, like we're sitting next to the plane, like you can say hello, but that's that, right? And then you start talking to people, and I met so many interesting people that are obviously I would have never ever met otherwise. But I've learned a lot from them.
I think you did a study that showed that venture capitalists have these much larger LinkedIn networks, right? Than normal corporate folks.
Not just larger, but wider. What we did is the following: is that we studied about 5 years ago. We started studying in great detail, even more than 5 years ago, corporate venture capitalists, because I saw the trend. I saw that corporate VC is becoming important. But the truth is, we don't know almost anything. At the time, we did not know almost anything about corporate VC. And frankly, what we did first with my colleagues is we did a survey. And for financial or institutional VCs, survey works fantastic. We learned so much. With corporate VCs, it was a complete failure. Why? Because even two corporate VCs, they even don't use the same terminology. They didn't actually understand how our questions and so on. So it was a failure. The one option was to give up. Another one was to double down. I decided to double down, which is we identified all the corporate VCs of S&P 500. That was the first stage. And we contacted them personally and interviewed them and went into those corporate VCs and studied in great detail everything, including their structure, their compensation, their decision-making process, and so on. Okay. And then we identified for all of those every single person who works there on the investment team, every single person. And we found their LinkedIn profiles. For every single VC, corporate VC, for every single person in that team, we then matched them using some criteria with institutional VCs. Okay? And so we have these two samples of corporate VCs and institutional VCs. And there are a lot of interesting findings. But one, as you alluded to, Greg, is that institutional VCs have first much larger LinkedIn profiles. Larger meaning, not just that they have more information there, but they have more connections. Their network is much, much larger. And that is because they're trying to go outside. They're trying to find those future Dropboxes, okay, and NVIDIAs. Corporate VCs, LinkedIn are much, much smaller. But there's something else, is that if you look at corporate VCs' LinkedIn profiles, they're very likely, their connections will be within their four walls. Or maybe if you come from another organization, there will be these four walls, okay, so to say, so that there will be fewer organizations where the connections are coming from. And you could see it if you map them. But for institutional VCs, it's not just you have, like 3 times more connections, but they're very different. They're from different industries. They're from different organizations. They're at different levels of seniority. They're from different educational background, and so on and so on and so forth. Because I think the diversity in constructive networking, as I call it, also brings a lot of new opportunities. And again, you need this, and this is a part of the venture mindset. You need this when there's something new, when there is something disruptive, when there is something unusual happening in your company, in your life, in your industry. And again, if your listeners would like to follow or become a bit more venture-minded, okay? So first, I'm sure that our listeners or viewers travel a lot, okay? So when you travel, try to meet at least one person.
Talk to Uber drivers. I always talk to them.
Yeah. Do you talk to Uber drivers?
I always talk to Uber
right.
drivers.
So that's okay. So in fact, when I talk to Uber drivers, very often I talk to them about who talks to them. And it's interesting because you get some statistics about how different people want to interact. But when you travel, try to talk to, and then think about your LinkedIn.
Yeah.
Think about your network. Think if it's a professional, think about your LinkedIn. Just go to your LinkedIn. Go to your connections, first connections, and identify, are there any biases? Or maybe too many people are from Stanford GSB if you happen to be an MBA, okay,
right.
An MBA student here. And try to meet or connect with some people meaningfully.
You used to be able to do a network graph in LinkedIn where you could see how many of your connections were connected to other connections, and I don't know whether they have that feature anymore.
Yeah, they used to have it.
So you could see if all your connections are connected to each other, then you're just in this little.
I think the reality on LinkedIn now is that you connected to almost every single person who is on LinkedIn of your second connection.
Right.
That is kind of the reality. But it's not just connection; it's a meaningful connection, right? Having some kind of so that person knows you, about you. And I think that's very important. So that is a very specific application of the venture mindset that that you can start using like now. Don't wait until this podcast is over.
Well, there's something you said first of all that, and this is a common theme in Silicon Valley, that you bet on the jockey and not the horse, right? And so you have to be very good at evaluating people, and I think. Jensen Huang was talking about this as well, right? Where if you hire good people, then you don't need to second guess their decisions and so forth. And so how does one develop that capacity to evaluate people? Does that require the same type of preparation as one puts into evaluating the technology or the business opportunity?
Absolutely. It's prepared mind everywhere. There's no doubt about that. With people, however, the truth is also with technology, but with people specifically, I don't think, definitely my research doesn't suggest, that there is one defining characteristic that determines whether that person is much, much more likely to be successful. So that whenever people talk ex post, after the fact, oh yeah, I met, Sergey Brin, I immediately knew that he would be a $1 trillion founder.
Right.
No, that is not true. Okay, in fact, so many people passed on investing in Google, including some famous VCs. There is no one characteristic. Yes, my research shows that there are a lot of characteristics that make people more likely to become unicorn founders, for example. Okay, so there's educational background, and there are a lot of variables there. There is an immigration background. So people coming from, let's say, Israel or India to this country, to the US, and founding VC-backed companies are more likely to become unicorn founders. And your previous employment, whether you're a serial entrepreneur and so on, those variables are actually all non-trivially important. But it doesn't mean there is one variable. And I think there are two explanations, and both of them belong to the venture mindset. One explanation is that many variables are not quantifiable, very difficult to quantify. And nowadays, everybody in the world, in the times of AI, says, "Oh, we're going to quantify all this." Well, let's see. But the second one is that I think there are a lot of features that characterize unicorn founders that are very difficult to spot unless you have prepared mind. So let me give you several examples, okay? One that many VCs told me. Let's say Paul Madeira, who is the co-founder of Meritech, a very successful kind of later stage VC. So this is what he told me when he meets the founder of founders. And of course, there's a presentation. And, he, as the venture capitalist, listens to the presentation and looks at the deck and so on. But what he is paying attention to is the team. How does the team that the founder, the CEO brings, react to everything?
So how do they react to each other? Right?
To each other,
Yep.
to the founder. Do they say something? Okay, because it's all about the relationship within the team, and how the CEO or the founders, how they react with the team. And if that relationship is not healthy, then he will not invest. This is one example. Another example is Mike Maples, the founder of Floodgate, that invests in very early stage companies and invested in a lot of fascinating companies. He thinks about whether these people that he considers backing are really passionate about breaking some existing patterns. In fact, he actually just co-wrote a book with a colleague of ours, a lecturer at the GSB, Peter Zibelman, on breaking pattern breakers, because that is his idea. So that he will not really invest in you unless he's convinced that you're passionate, meaning that, what does passion mean? You cannot think of anything else about breaking something. Now, it doesn't mean that everything that he's going to invest in is going to be successful, because it is in fact difficult to break pattern. But if you succeed, then it's going to be something very big. So those are examples of the traits of founders that successful venture capitalists trying to invest in future unicorns are trying to see.
I want to get back into decision making, because we talk about how you have to be passionate and you have to be committed and you have to have a singular vision, but you also have to be open to listening to what others are thinking and what's happening around you, and you have to be humble enough to reject your ideas when they are perhaps lacking in rigor. So how does one avoid becoming a behavioral investor? I spoke recently with a venture capitalist. It was a couple of years ago when the crypto bubble was really operating in full steam. And he said, venture capital is behavioral investing disguised as fundamental investing.
Okay.
And so a lot of venture capitalists, they are making decisions by looking to see what the other venture capitalists are doing. Now, of course, that's perfectly rational, but how does one calibrate the degree to which one trusts one's own judgment and the extent to which one has to listen to others who are differing in their judgments?
Yeah, that's a good question. I would not describe early stage VC investing as something that is similar to traditional fundamental investing. For example, what equity analysts do day in, day out. Behavioral is very important. Now, behavioral is very generic, which is, it's really about how we behave. So all of us have certain behaviors, okay, whether we know about it or not. I think the most successful VCs, first of all, they do know that they're very much subject to FOMO, fear of missing out. And fear of missing out drives them because you don't want to miss something that is going to be big, right? But there is something else, which I think is a huge part of the venture mindset, is that if everybody invests and there's a craze about it, obviously it means there's also going to be crazy valuations. That also means that you're likely too late for the party. It's likely that even if everybody is right, your return is going to be...
So you got to be right and rare, right?
Yeah, but you cannot be rare if everybody is doing that. And as a result of that, I think the best way those who follow the venture mindset think about this is we have to be right, but there should be a lot of disagreement. if there is consensus that everybody is going to that crypto is going to be the next craze. Well, right now the generative AI is going to be the next craze. Okay, if everybody are right, then in fact you're going to be right, but your returns are going to be relatively small. You would like to be right when you are what we call in the book Mr. Contrarian. Okay, somebody who goes against the crowd, who either invests early enough before it is discovered, or maybe who disagrees. By the way, and I think that is really important to understand, and I really would love our listeners to understand this, because it doesn't apply with respect to the market, but also with respect to their decisions. So most of you are going to make decisions in a group. And if, whether it's 5 people or 20 people, you get around and everybody votes yes, or everybody says that's fantastic, that, of course, is consensus. And in traditional organization, when you're doing traditional decisions, that's a good idea to have consensus for various reasons. But whenever you invest in startups, or whenever you invest, or whenever you're making decisions about something that is potentially disruptive, or when there's a lot of uncertainty, when you don't know a lot, if everybody agrees, that's likely a bad idea. So you in fact want to develop situations where there is no consensus. And you would like to be able to trust your contrarians. So I think that is really important for the entire market, but also for every single organization.
Now, I think there's another part of the venture mindset which has to do with the trade-off between being a specialist and a generalist, right? So obviously the founder of Zoom, for instance, that you just talk about in the book, I mean, this guy knew everything there was to know about video conferencing, right? But venture capitalists will often say, I don't want to invest in the expert because they know all the reasons why the world has to be exactly the way it is, right? So how does one identify someone who is an expert, but also something of a rebel, right? You talk about that in the book.
Yeah, I think, thank you, Greg. I actually think that is very important. First, when you say generalist or specialist, an expert is somebody who knows a lot about what is known now. It doesn't mean that is going to be useful for the future, or that it is going to be, fixed, unchanged, static. The world is fast changing, and what you know now might not be relevant or might change quite a bit tomorrow. And so what I think smart VCs are looking for is somebody who ideally understands the topics or has the expertise, but is also flexible, agile, amendable enough so that to pivot whenever new information comes in. And the new information will show that the world is actually different. Now, you mentioned Zoom. Zoom had great difficulty raising money initially. And it was 2000.
SASB?
In fact, Zoom was not called Zoom at the time as well, right? It was called SASB. I mean, would you invest in SASB? SASB, the idea for SASB is software as a service B, like, hardworking kind of B. So SASB had great difficulty raising money initially. So it was more than 10 years ago. And indeed, if you think about this, Cisco had a working system where, in fact, Eric Yuan worked. And then there was a Blue Jeans around. GoToMeeting, and there were others.
Skype.
Skype, in fact, was bought by Microsoft recently. Okay? And, of course, none of those worked very well on mobile. And I think the original idea of Yuan was, well, I'm an expert in this, okay? But in fact, the revolutionary idea is to ensure that it works smoothly across all the systems. So I can have an iPhone, you can have an Android, and the third person can use a laptop, and the fourth person is a PC, and we're all going to work, to talk to each other and see each other at the same time. Okay. Now, right now it seems, it's an obviously great idea. Of course, it was not obvious at the time, and in fact, many investors turned Zoom down. And amazing enough, and we show this in the book, is that even those investors who invested not because they all agreed that it was a great idea, but because, having the venture mindset, they developed a mechanism to support their contrarian views. So to give you one example, Nagraj Kashyap, who at the time was the head of Qualcomm Ventures, corporate VC arm of Qualcomm, and as the head of the corporate venture group, he designed it. And one element of the design is that there was no need for a uniform agreement for small deals. And again, maybe it seems obvious to listeners, but it isn't obvious. And I can, trust me, when I talk to these dozens and dozens and dozens of corporate VCs today, many of them still require consensus on everything. And as a result of that, when the most of his team voted the Zoom investment down, again, for good reasons, okay, there was a leeway, there was a possibility for contrarians, so to say, on his team to make small investments. And he encouraged that. Of course, he was in favor of investing, but most of the team was against. Mm-hmm. And so the venture mindset is not about, seeing Eric Yuan and saying, oh, he's a genius, let's invest in him. That is not the venture mindset. So the venture mindset doesn't mean that you have a perfectly crystal ball recognizing these great founders and great ideas. The venture mindset means that you, in an organization, build structure, build decision-making process. What we also call it, build racetracks. So that again and again and again, you will be able not just to spot, but also to realize those unusual, contrarian investment opportunities. And I think that most successful VC firms that I studied, well, actually all successful VC firms that I studied, that have been successful for quite a bit of time, they all follow these principles.
Mm-hmm. So, I mean, it's clear that the mindset is complementary with the organizational design, right? If you don't have your firm organized with the right incentives and roles, then this mindset it will actually be career killing. Right? It won't be allowed to thrive. And I think one of the mysteries in economics, industrial organization, going back to Schumpeter, is why do we need new firms in the first place, right? Why don't incumbents just do all the innovation? And I think if people take your work seriously, then they might start behaving more like Amazon, because Amazon clearly has incorporated a lot of the venture mindset, and some of the other large corporations have. So could we imagine a world where we no longer need venture firms because the large companies will have figured out how to do innovation? I mean, they have all the advantages, and they have customers, and they have know-how, and they have all this other stuff, right? So couldn't they just adopt this mindset and adopt the right incentives and then put all these Sequoias and Kleiner Perkins and Benchmark out of business?
That is a great question, Greg. And in fact, my co-author Alex and I have been thinking exactly about these issues recently. And the reason is the following. If you look at 2023, then I think for the first time, both in the US but also globally, if you look at the totality of venture capital investments, then for the first time ever, most of the venture capital, the majority, not the most, the majority of venture capital investments were made not by Sequoias of the world, so not by institutional VCs, but by corporate VCs. Not many people realize that corporate VCs now play truly an important role, okay? So that's why I study them. That's why I go and meet with all those leaders, asking me about how to design those organizations. And I think that corporate VCs, as they adopt the venture mindset, they're going to play a larger and larger role. And I do believe that even larger organizations, not just corporate VC arms, but larger organizations, if and to the extent they become more venture-minded, again, in some of their parts, they're much more likely to succeed and survive, for the next 30, 50 years. But not everybody will. So as a result of that, I think that the venture mindset is not just, a cute movement, but something that you need as a large organization to survive over the next several decades. But I don't believe that institutional VCs will disappear. They will change. I don't think they will disappear. And the reason behind that is that if you're a large organization, then you should work on expanding your work outside your four walls. But your four walls are becoming larger. Okay? So right now we're in a small studio, but imagine that you were in a football field. So walls are further and further away, meaning that it takes more and more effort to look outside. And I think that VCs will adapt to find the new generation of small startups, not just inside, but outside large firms. And then will work collaboratively with those large firms. I do think that the $10 trillion companies are being born right now. Everybody's telling me, my students are telling me right now, well, that's a pretty difficult year, professor, to become a venture capitalist or raise funding unless you're in generative AI. Yes, but it also means that in fact you're more likely to be successful if you raise funding. And I think those are going to be funded both by institutional VCs and by corporate VCs.
Well, I want to turn to business education, right? Because we're both in that business, and I think of myself as spending half my time helping my students to learn, and the other half of my time helping them to unlearn, right? So when we look at a traditional MBA education, it seems to have been designed for success in the corporate world, right? And of course, the corporate world is the majority of the business roles. Do the folks who come out of business school and succeed as venture capitalists and as founders do so in spite of their business education? Or are we kind of figuring out in the world of business education how to facilitate things like the venture mindset?
That's a very good question. I do believe that the leaders of business education specifically and education more generally should also acquire the venture mindset. And in fact, we did incorporate several pieces about education in the book as a result of that. I think that traditional business education, as you correctly pointed out, was oriented more towards the traditional mindset. And so, this is not just basic finance or accounting, but a lot of education. However, as I look more and more recently, let's say at Stanford GSB, then I think there are more and more courses, especially elective courses, being offered that are more oriented towards the venture mindset style education. And I believe that you should get both the fundamentals, so that the most important part in applying your education is not to know facts,
Right.
is to be able to learn the new facts very quickly and to go to the first principles. Again, going back to what Jensen Huang said, he's studying every single day. Now, he's studying because he has the ability to process new information, go back to first principles, and to correlate it with whatever he already knows, right? And I think that is a very, very important skill. Again, it's about being the prepared mind. So let me give you an example of course, of the class that I teach, where one of the classes I teach is on venture capital, and I think about 70% of the students are entrepreneurs who would like to become VC-backed founders, and many will become VC-backed founders. And then about 30% want to become VC investors or some kind of other investors. And the way we designed this class, we is my co-teacher and co-founder of Emergence Capital, Brian Jacobs, and I, the way we designed this class is, in fact, according to this venture mindset principles. Let me just give you one example, okay? So we invite real startups to come and pitch to the class. Real startups that right now raising Series A or Series Seed. why I insist on them being real startups. And trust me, it's very tough for Brian and me to find all the startups that exactly in that week in October, okay, trying to raise Series A. That's tough. Why? Our MBA students are very smart. If I give them NVIDIA, okay, or Dropbox, they will Google and or maybe now they ask ChatGPT and they will immediately know the outcome. Once you know the outcome, you're biased. You talked about behavioral biases, Greg. So nobody, like Brian doesn't know, I don't know, students don't know, the founders of the startups, they don't know whether that is going to be successful, whether they're going to raise money. And then we put the students in groups of 6. Why 6? Because a typical venture partnership is 6, even though nowadays there are some partnerships become pretty large. And they have to make decisions in the group. And it's not about the outcome of this decision, but about the process. So when we discuss the submissions, when we discuss the outcome of this case, like we call it, I think, the future unicorn case, we discuss not whether that startup was better than the other startup. That's kind of irrelevant by that. What's important is the process, how you make decisions, especially when, let's say, you disagree with each other, or how do you do due diligence? How do you process information? How do you communicate that information to everybody else on the team? And so, and I can continue this forever. So I think that is business education. And I don't think that is a traditional business education. That is the, hopefully, venture-minded business education.
Now, that means that the institution has to take pedagogy seriously and has to think about the final product, which is the student coming out on the other end, right? And presumably you want to track their success. You want to listen to the, quote, customer, who is whoever will be interacting with these folks after they graduate. I mean, that requires a lot of work and a lot of reflection. Is that difficult? I mean, there are so many pressures on academics to publish and be relevant within their research field that this seems like something that is potentially at odds. How do you combine those two? How do you combine the academics with the pedagogy?
Well, I can tell you, first of all, it's very difficult. I know this myself because I follow, on LinkedIn at least, every single student that ever came through my classes here. So I believe I have around 2,600 students that I now follow on LinkedIn, and well, 98% of them are there. And in fact, I process a lot of statistics about them, what happened to them. And, I have my notes about them from sometimes 15, 20 years ago. And by the way, yes, most of them, of course, have grades because we have mostly graded classes, and we still have forced grading curve. But grades actually matter less for me than my notes. So I care a lot about students' aspirations and whom they want to become, what they want to achieve, and I'm trying to see not just whom they became, but how they became, and what kind of. I was always curious about what kind of information knowledge they used, but it's a lot of work, and I'm not really sure I know anybody else who is doing that. Hopefully other professors are doing this as well. What I don't believe in, and that is a part of the venture mindset applied to education, but also to any organization, is that there's one fantastic ideal approach that fits everybody. I don't believe that, at some point several years ago, and I'm sure, Greg, you went through this, flip classroom were very, very popular. Okay? This is a great idea, but I don't believe that it should be enforced. I believe that the diversity of approaches is very powerful. Again, going back to what we discussed at the very beginning about the CFOs, I don't believe that we should have like investment project the same approach to all the courses. But of course, there should be a portfolio approach. So to the extent that people care about teaching, okay, and care about the input and output, I think that different professors, different people apply those differently. There's different pedagogy. I don't believe that my pedagogy is I love the way I do things. Okay, but there's always room for improvement as well. But I don't believe that it would fit many other people. I'm not saying that it's better than what other people are doing. So I believe in many differences in approaches.
Well, it's been great chatting with you. We didn't get through all 9 of the different facets of the venture mindset, which is, of course, the title of the book. I'll show you this. This is the fake cover, Venture Mindset. Believe me, it's a lot more colorful.
Soon you'll get. So I think you should. You really can already buy it.
Right.
You should go and buy it.
How to make smarter bets and achieve extraordinary growth. Thanks so much.
Thank you, Greg.
Okay.
Unsiloed podcast is produced by University FM, elevating the stories of your institution.